Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Lead. The Pilar Two engine for PwC is a game changer for Pilar Two modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is built by a team of Pilar Two tax experts from around the globe. PwC's Pilar Two engine is currently available as a service and is now available to license. This week's episode of Cross-Border Tax Talks, we're in Madrid, Spain, at the PwC Global Transfer Pricing Conference 2024, where I'm excited to have Pieter Dere on the podcast. Pieter is a tax partner at PwC Belgium, part of PwC's International Tax and Transfer Pricing Group, where he's leading PwC's Belgium's Pilar Two efforts. Pieter, welcome to the podcast.
Thanks, Doc. I'm very excited to be here.
And you are one of the aforementioned Pilar Two experts from around the globe that's helping with the Pilar Two engine. So I'm very excited to have you on. Before we get into Pilar Two, Pieter, you are a fellow podcaster, the Tax Bites podcast. Tell us a little bit about your podcast. I am a subscriber, but tell us a little bit about it. How often do you publish, and where can listeners can find your podcast?
Yeah, thanks, Doc, for making a bit of publicity. Yes, I started my Tax Bites podcast in the middle of COVID, when there was a need for just having something to listen to and things like that. And so the idea of my podcast is to update the audience on developments relevant for, let's say, European headquartered international businesses. And it forms part of our tax intelligence community in Belgium. So a group of clients that are looking for really tailored information. Yeah.
Great. Where can we find it?
Well, it's on Spotify and on the website of PwC, all the usual sources. And we try to record basically the idea every time there is a relevant development, with the same aim for once a month recording.
Yeah, so everywhere you can find your podcast, because it's on Apple, iTunes, Stitcher. I did a little homework before to be able to make sure that our audience can find it. Great. So I would encourage people to check that out. Very informative, and particularly with a European angle. And frankly, I think it's relevant even for US MNCs and others that are operating in Europe. But I appreciate that the angle is more for the European parented. I mean, frankly, I started this where the angle was more for US parented groups, and it has certainly with Pilar Two evolved much more broadly than that. All right, so Pieter, let's move into Pilar Two in Belgium. I am very excited about this podcast because Belgium has been front and center for a whole number of reasons that we're going to go through, particularly this registration requirement that I think snuck up on a bunch of taxpayers and advisors. We're going to talk about this lawsuit that was recently filed by some big U.S. Chamber of Commerce organizations. But before we get into any of that, let's set the table. Where is Belgium for an overall Pilar Two process? And let's start with IR, QDMTT, UTPR. Have they enacted? When is this stuff effective? Give us a little bit of background on where Belgium is.
Yeah, my pleasure. So Belgium enacted Pilar Two. We are a constitutional democracy. That means it needs to be in the law. No tax without law. So one of the particular challenges that Belgium had was to translate the ongoing guidance that was published into Belgian legislation. It's fair to say that the current legislation incorporates all the guidance until the early 24, when the last update of the legislation took place. And a further update will be needed just to incorporate the latest changes in legislation. So we have the income inclusion rule, of course. We have a QDMTT. Belgium is very close adhering to the OECD principles, so the UTPR, everything, it will be all in there. That's the current status, Doc.
So the income inclusion rule, that is effective 2024 per the EU directive. QDMTT, or the domestic minimum top-up tax, also effective 2024. And then the UTPR will be effective for 2025.
Yeah, exactly. That's fully correct.
And then help me understand, so the administrative guidance. So we have the February, July, December 2023 guidance. Has that been incorporated into the Belgian domestic legislation?
Yeah, Belgium takes here two ways. Yeah. On the one hand, if it's needed to be in the law, it has been included in the legislation, but the law is very close to the text of the directive. That means that a lot of administrative guidance in Belgium at Belgian level will still be needed. So we do expect circular letters, further guidance, commentaries, Q&As from the tax authorities, which are not yet there. So there's a bit of a a vacuum there still.
Yeah, and that's what's been very fascinating for those of us, as you know, where we're trying to design the calculation engines for provision and compliance and even modeling purposes, is that, depending on the particular jurisdiction, which I've learned, many countries do not incorporate sort of that minutia detail, right, in their statutes, in their domestic legislation. So it sounds like Belgium has circulars and other Q&As. Do those things have the precedence and of actual law? In other words, that taxpayers actually have to follow?
Yeah, it is a very common way of providing legislative details and guidance in Belgium circular letters. So Belgium will follow the OECD as close as possible, the European directive as close as possible, and those have indeed a binding character for the taxpayer. Yeah.
So you mentioned you are a constitutional democracy. How does retroactive rules work? So it sounds like some folks in Belgium are making the decision of whether it needs to be incorporated into legislation or whether it can go into one of these circulars. The OECD has promised a whole bunch of additional administrative guidance, as you're well familiar. And most of or at least all the administrative guidance, frankly, that we've seen to date is all intended to be retroactive, right, to the initial starting point of Pilar Two. So in Belgium's case, 2024 for the IR and QDMTT. How does that retroactivity work for Belgium? And does it depend on whether it's considered guidance or law?
Yeah, indeed, Doc. So retroactivity is generally not allowed in Belgium. Retroactive means that the law is not passed before the last day of the financial year. That means for a normal company subject to Pilar 2 with a 24 accounting year, the law needs to be passed before the end of December of 24. So we do expect maybe some additional legislative changes there. So the law has been passed in December 23 with changes in 24. That means generally there is no retroactivity. Circular letters can be interpretative and can go back, although it's not considered, strictly speaking, as retroactive. So we do expect further guidance to come out in 25 before the first filing deadline that will interpret and provide further guidance on the legislation in 24. That is perceived to be retroactive. Strictly legally, it should be okay.
And so help me understand that. And so maybe, for example, the December administrative guidance that had some of these very specific rules on transitional safe harbors, which are causing taxpayers, I think, a lot of consternation as they're going through their process to determine whether they have a qualifying country-by-country report. That came out in December, so presumably that was not included in the domestic legislation. Will that be included as a circular, and is that considered more interpretive, so it can be retroactive?
I should hold you there because the first update already took place in the beginning of 24. Okay. And that guidance has been included. And what we see that, I think, after that date, the further guidance is in the benefit of taxpayers. So we would not expect taxpayers to go against a further simplification or extension of certain options under the guidance. However, if there would be a more restrictive rule in the guidance, which has not been enacted, strictly speaking, that gives uncertainty. And we can think about certain of the anti-hybrid provisions, for instance, which are not in the benefit of a number of taxpayers and which are included in guidance, which came out later.
So let's go down that hypothetical. So let's assume that the OECD honors what it has said publicly, and we end up with administrative guidance before the end of 2024. Practically speaking, can Belgium get that administrative guidance incorporated into domestic legislation, or how would they do that for it to be effective for 2024?
Yeah, well, what I expect that will happen is that in the course of 25, this additional guidance that we expect to come still will be included in the circular letters, Q&As, etc., and that taxpayers can, on that basis, rely on that, benefit from that. As I said, the main uncertainty will be if there are restrictions in there or less beneficial provisions, because then you have a legal question whether that is enforceable, and that will have to be judged in one of the courts, I'm afraid.
Peter, I am no expert in Belgian constitutional law or tax law for that matter, but I will anticipate the number of the rules that come out on the administrative guidance, and you mentioned one, which is the anti-hybrid, will not be taxpayer friendly. And I think this, and there are other jurisdictions in addition to Belgium where there's going to be some very difficult sort of constitutional questions with respect to whether these things can be retroactive or not. And frankly, I think we'll see if the OECD is able to get out this administrative guidance in 2024. I think, to your point, it's much more likely that we're going to see this in 2025. And it really does beg the question of this retroactivity. And I think what maybe some listeners don't appreciate is that these constitutional questions are jurisdiction by jurisdiction. And so it is every country that has enacted the 40 that are enacted, taxpayers are going to have to do that assessment to determine whether something could or should legally be retroactive.
Yeah, absolutely.
All right. So I want to spend a little time talking about some of the nuances on the Belgian rules. Because might even be differences from the model rules. But wanted to start with the QDMTT. This is a question we get a lot, something you can find on our Pilar 2 tracker, which your team has been instrumental in helping keep update from a Belgian perspective. The QDMTT, is that based on local stat or the financial accounting standard of the ultimate paradigm?
It's the ultimate paradigm, Steve. That's for sure clear in Belgium.
And this surprised me a little bit. The number of, I thought most countries, Peter, frankly, would have picked local stat as opposed to the financial accounting standard of the ultimate paradigm because it's just going to be easier to audit. I mean, I think, for example, like a U.S. multinational that operates in Belgium, the Belgian tax authorities are going to have to review the QDMTT in Belgium based on U.S. GAAP principles that we've learned from working together that there are significant differences between U.S. GAAP and IFRS over the course of the last couple of years, which I think it's going to be challenging. How do you think Belgian tax authorities will they have to be trained? Or what is your thoughts on the practical aspects of them auditing a system based on U.S. GAAP, for example?
Yeah, I can first of all confirm that there's going to be a huge challenge for the Belgian tax authorities. They are not used to work with other standards than Belgian GAAP. They are not used to work with deferred taxes because that's not existing, basically, in practice in Belgian GAAP. So what happened is that the tax administration has been hiring massively a separate team of Pilar 2 experts in the past months. And I know that they are currently going through a full training program to get all these topics on the agenda and to update them on that. So we're going to meet 50 or 60 new tax inspectors, I think, in Belgium, trained specifically for Pilar 2.
Wow. Okay, so let's move on to the UTPR. A common question and something I've been very focused on interesting is that obviously comes in 2025, as we discussed. The application for payment, is it a denying of deductions, or does the Belgian entity potentially have to pay their portion or relevant portion of the top-up tax paid?
Yeah, legislation still need to be shaped, but it's going to be an additional payment. That's what we're looking at, and I'm probably will have to come back on that later on when we talk about the case, because that's one of the arguments put forward.
Yeah, on the legality of the UTPR that actually does require a top-up tax payment. And just as a little bit of teaser for that discussion we'll get into a little bit later here in the podcast, the issue is that if you have a small little Belgian subsidiary, and let's say hypothetically that is the only country that has enacted the Pilar 2 rules in your group, and you have a large low tax subsidiary, that Belgian taxpayer could potentially owe a tax liability far in excess than the equity on its balance sheet. In other words, it could effectively make it bankrupt. If it is a brother-sister company, for example, to that low tax. So we'll come back to that on sort of the constitutionality point, but I think it's important for listeners to take account that the model rules anticipated really denying of deductions for taxpayers on this UTPR. And many of the countries that have brought in the UTPR have not followed that under the model rules and require a top-up tax payment. All right. Another interesting area where Belgium, I think, is kind of out on the forefront is advanced tax payments for Pilar 2. What are advanced tax payments under Belgian rules, Peter, and how do they apply for Pilar 2?
Yeah, well, advanced tax payments is a very well-known system for Belgian taxpayers because it's something, in the normal corporate income tax. Basically, it means if you have to pay your estimated corporate income tax, for instance, for 2024, in 4 installments throughout the year to avoid a tax increase. And for this year, it's quite significant. It's a 9% increase that you incur if you didn't pay advance payments or not enough advance payments. The Belgian legislator has chosen to extend that to Pilar 2 payments, the system. My guess, and it's not such a wild guess, is that this has to do also with a budgetary reason. That means that you force Pilar 2 payments to be paid already in 2024. Yeah, and I said 4 installments, but taxpayers in Belgium will know that for the first year, you have until 20 December 2024 to make your advance payments for Pillar 2 taxes.
So it gave taxpayers at least some room that they didn't have to make the Q1, Q2, or Q3 payments. It's really Q4, kind of they get the opportunity to make the catch-up payment. And is that for both QDMTT and potential income inclusion rule taxes?
Yes, that is for both. And to make it easy, it's a separate system. So if you have to know whether you expect to pay QDMTT rather than income inclusion rule taxes, and you have to make separate advance payments for both of them. Since there is a very close connection between the normal corporate income tax paid and the QDMTT, the tax authorities will, however, switch excess amounts between the two systems. So if you paid way too much of your income tax, you overpaid corporate income tax, and you underestimated your QDMTT, they will switch for you in your benefit the advance payment.
Yes, Belgium, you guys are out ahead of thinking about the actual administration and practical. This is fascinating. So let's talk about the QDMTT return. When is it due, and any insight on when Belgium may actually produce a return for taxpayers and frankly advisors to understand what's going to be required in the QDMTT return?
Yeah, well, the due date for the QDMTT return is end of November 2025, 11 months after closing your financial year on 31 December 24.
I'm going to interrupt you. So not the July 1st or June 30th, 2026. This is a 2025 requirement.
Yes.
Sorry.
Subscribed in the law, so clearly that's not going to change. That also has to do, in all honesty, with a budgetary reason. A tax return filed in November 25 is taken into account for the budget 25. That's just a public known fact, I think. So that deadline is known. When will the tax return be published? Because that's a big uncertainty. What level of detail will you need, etc. We do expect a tax return draft at least to be published in the coming days, because it's quite a high pressure. We need to know how to prepare for the tax return, etc. We don't know yet what will be in there, but if we look at the notification, which we probably will talk about also a bit later, we do see that Belgium asks for quite a bit of detail on the legal structure and other elements. Knowing that tax assessment will be due in Belgium by the tax authorities before you file your bill of information return, I can only guess that quite a substantial bit of information will be needed in that QDMTT return to enable the tax authorities to just assess the tax base.
So by the time this podcast is published, we will likely, it sounds like if it's coming out in the next few days, we'll likely already have that first QDMTT return to be able to parse through. So you had mentioned this Belgian registration requirement. Let's go straight to this, because this was very fascinating. There have been a number of countries that are requiring registrations for Pillar 2. And when we say registrations, effectively notifying the taxing authorities in a particular jurisdiction that an entity or a group specifically will be subject to the Pillar 2 rules. Most of the countries that have a registration requirement, that registration requirement is sometime later in 2025 or 2026. But Belgium's registration requirement had a much tighter timeline when it came out. So tell us a little bit about that, Pieter, because that did cause quite the stir amongst us Pillar 2ers around the globe when that registration requirement came out.
Yeah, I can imagine that. All of a sudden, it was a very short deadline to produce quite a bit of information. I've heard bits and pieces from various sources. One of the reasons that things had to go that quickly was because of systems in Belgium. Or IT system of the tax administration needed to enable to have a registration number. They needed that information, and it takes quite a bit of time to register a company. So registering all of a sudden 2,000, which is the expected number of taxpayers in Belgium subject to Pillar 2, registering 2,000 groups in Belgium would take time. So that's why they put pressure. The initial deadline of early July has luckily been extended with a few weeks.
Yes, talk a little bit about that. What specifically was the registration timeline, and then they gave taxpayers a little bit extra time?
Yeah, they said if you want to make advance payments, you need a registration number. I said already, 20 December is the deadline. So groups that need to do advance payments needed to have the number as soon as possible. So in May 24, they said you have time until early July, 13 July, to file the notification form. Then you can guarantee that you have your registration number in time before 20 December to make your advance payments. They also said, well, if you don't want to do advance payments or you don't need to do advance payments and you have a bit more time, you were given time until 16 September to file your notifications. Now, for any taxpayer out there who has not yet registered, and I'm sure there will be, know that it's important to do the registration as soon as possible. And there are no penalties on late filing notification, but at least you get your number as soon as possible then.
And the potential consequence for taxpayers that don't do the registration is that then you are unable to make the advance payment. If you do have a top-up tax and you're unable to make the advance payment that you said was a 9%
increase,
which that hurts. Yes. So a good incentive to get that registration. Tell us about, Peter, what information was included, because there was quite a bit that I think took many taxpayers by surprise, the volume and type of information that was required as part of the registration.
Yeah. Well, a couple of things needed to happen. If you are subject to Pillar 2, you need to appoint one entity in Belgium that will be responsible, liable for your tax. So first of all the entities in Belgium needed to sign an agreement and appointing one entity among them who would be towards the tax authorities liable. So if you have two entities in Belgium, it's quite easy. I have clients who have 300 entities or something like that. They had a huge signature round doing DocuSign or other systems for that. So that's the first challenge. And then you had the notification itself. What was included there? Some obvious data. You need to choose a name for your group. You need to have an address, a person that could be contacted. There were two burdensome areas in that notification form. One was the legal chart. Groups were required to disclose the UPA, all the intermediate parent entities, not only Belgian, but everywhere in the group, and all the partially owned parent entities, not only the Belgian, but everywhere in the group. And then, of course, all the Belgian entities which were not yet disclosed. That means you had to disclose a very large part of your group. And many of the companies that I contacted were not yet ready with the legal analysis on Pillar 2, because they have time normally until 2025, 26. That put on a huge time pressure. Second element is that the ultimate parent entity needed to have a contact person in Belgium registered with the tax authorities. If you have a Belgian with a Belgian registration number, that's fine. But obviously, if you have a foreign UPA, there's no director there who is a Belgian, maybe. Then you need to register that person with the Belgian tax authorities in advance to get a special number. All of that came with a bit of it was quite time consuming, I would say, to connect.
Yeah, in addition to being time consuming, I think there were a number of taxpayers that were very concerned with respect to giving up or disclosing their entire org chart. I mean, because that is otherwise information or data that the taxing authority in Belgium has never had. And I think that is one of the big pieces of information globally that, taxpayers that have historically kept a very tight grip on their legal entity organizational chart are now going to have to cough those up and give those up to taxing authorities. And you can understand the taxing authorities need to know what the group structures are to understand who's potentially in scope, where would they apply UTPR, is IR relevant. So you can certainly see the need for taxing authorities to have that information. But I think many clients, many taxpayers were concerned about what could the Belgian tax authorities effectively do or share that information with others. Were you seeing similar concerns?
Absolutely. And a question often I got is, what if the information is not complete? But that could be honest, the registration numbers were refused if there were indications that the information was not complete. So a number of companies had to correct their notification if there was missing information.
Yeah. And the other point, particularly with the missing information, is that effectively what it required taxpayers to do who were planning to do this registration, you had to do your legal entity, what I've referred to as the constituent entity analysis, to understand who's in scope, who's out of scope. Do you have minority-owned constituent entities, partially owned parent entities? For companies that have a lot of joint ventures, that is a complicated analysis and certainly something that needs to be done before you would even register so you know what to disclose. And so I think for those taxpayers that maybe hadn't done that work and accelerated the need to be able to do that.
Yeah, and I can maybe just add, Doug, that at least one company that I was in contact with has a discussion, who is my UPA? There were potentially two UPAs, but because the rules were really not clear. Questions have been raised with the authorities, with the OECD even, I think, to just check that point, and they didn't know. And then I must say that the Belgian authorities were quite open and flexible to understand these situations and to give wherever they could time, room, etc., to facilitate these taxpayers. And best effort was requested, but if you did your best effort, then we saw.
This is a great point, Peter, and that for the big public companies, big publicly traded multinationals, which I would argue that these rules were designed to impact, it's pretty easy to find who's the UB, who's that publicly traded parent company. But in the private equity space and fund structures and private capital, it is a lot more questionable with respect to who is actually the UPE and the type of legal entity it is, where it's subject to tax. And your point is well taken in that some of these rules are just unclear at making the determination of whether something is a UPE is not precisely clear in the rules. And certainly if you need to register who the UPE is, that can be very challenging. And from a practical perspective, who's the right person to answer that question, right? Because you go to the Belgian tax authorities and they say, well, would we go and talk to the OECD? Like, this is really uncharted territory from an international tax landscape with respect to, because normally I think taxing or taxpayers in Belgium would go to the Belgian tax authorities and they would just tell them.
Yeah, exactly.
All right. So that's one of the issues that you're seeing with Belgian taxpayers. Wanted to talk about maybe a couple others. Patent boxes. Talk a little bit about the patent box regime in Belgium and how Pilar Two is sort of changing the landscape with respect to the Belgian patent box.
Yeah. So we have seen that the Belgian legislation in a number of areas was not really fitting the OECD rules. For instance, our tax credit for research and development was repayable over 5 years, not over 4 years, while the OECD is putting, as most of the listeners know, a 4-year threshold. That was adapted to 4 years in line with the spirit of the OECD. In addition, our patent box regime has been adapted so that companies can basically decide not to use their full patent box, but to even convert part of the patent box in a non-refundable tax credit, which can be used in later years. So companies can choose to basically increase their domestic corporate income tax level to up to 50%, where the patent box would maybe go lower in some cases, and pay just 15% Belgian corporate income tax, and then be okay also, of course, to the Pilar Two QDMTT, while in future years they can still use that credit. So Belgium adapted that. That gives an additional uncertainty for the advance payments, because as a company, what do you need to do? Well, you have to decide today whether you will use that scheme or not to anticipate where to make your advance payments. So this creates quite a bit of calculation and uncertainty.
Yeah, you got to do the math. So just to state that back, effectively, the Belgian policymakers effectively put a dial in that allows people that are operating in Belgium to effectively sort of dial up the tax up to the 15% Pilar Two rate, but still preserve those benefits from the patent box until later years when maybe they would be at a higher rate, would have to pay a Belgian top-up tax. But you have to do that math, to your point, to understand what your potential advance payment is.
Exactly.
All right. So the other sort of big issue, and we've alluded to this throughout the course of the podcast, is the time pressure that these rules in Belgium now put on multinational groups, right? So presumably Belgian parented groups kind of understand, are all over this stuff, but for any other parent group that's subject to Pilar Two, whether that parent company is in a jurisdiction that's implemented the Pilar Two rules or not, if you operate in Belgium, you now really need to accelerate your Pilar Two data process. And if you're going to meet the transitional safe harbor with the QDMTT, how is that impacting taxpayers that operate from a timing perspective, taxpayers that operate in Belgium?
Yeah, a lot of taxpayers in Belgium are now looking for additional resources. We have seen a lot of job openings for Pilar Two experts.
Including the governmental authorities.
Including the government authorities. So it's indeed a scarce resource if you know something about Pilar Two in Belgium. So it puts on an enormous pressure. You need to speed up the legal analysis, the data collection, everything else, especially for groups who are not benefiting from a safe harbor in Belgium. Luckily, there are quite a bit who do push it, and then that gives them probably less pressure in terms of details that you need to collect. But the legal entity analysis needs to be completed this year. Yeah.
All right. All right. So a couple more questions, but one is qualification of whether something is going to be a qualifying inclusion rule, qualified domestic QDMTT, whether we're supposed to get additional guidance from the OECD with respect to incentives, which as an aside, Peter, I think it's very fascinating that the OECD is also not only giving administrative guidance relevant for taxpayers, but now they're giving administrative guidance relevant for taxing authorities implementing or enacting jurisdictions. But any thoughts on where Belgium is with respect to the qualification? And obviously, I think, or at least to mention listeners, there's the self-qualification, the self-certification that taxpayers can do. But any thoughts of where that may be going beyond once we get past the self-certification?
Yeah. So Belgium is really working hard on the self-assessment of the QDMTT. I think that also puts a bit of pressure on their ability to really help taxpayers with questions, for instance, for notification or otherwise. There is a helpline. Taxpayers can ask questions to the authorities, but I think they are reluctant to answer or take position in that, knowing that the position they take might mean that they deviate from the QDMTT and would impact the self-assessment and the qualification. Belgium really wants to make sure the QDMTT is qualifying. The self-review process is still ongoing at this moment. That I know. It's not yet finalized. But looking a bit at the rules, I think, everything has been put in action to make sure we are consistent as Belgium with the QDMTT rules put forward by unions.
And that is very consistent. As I talked to our teams around the globe, that obviously the reason the countries are enacting these rules is because they want that to be qualifying, whether it's the QDMTT, the inclusion rule, any changes to incentives. I think it's very interesting that Belgium changed its refundable tax credit from 5 years to 4 years to fit within that standard set by the OECD. It certainly will be interesting to see how taxing authorities adapt to this. And the qualification process, I think, is going to particularly be interesting for some of those jurisdictions that were very heavily incentive-based. And I think, frankly, Belgium has just gotten away from that over the course of the last 10 to 20 years, let's say. But obviously, the patent box is one of those types of examples. All right. Last topic, and this one is very interesting. So in July of 2024, there was a claim filed in the Belgian Constitutional Court challenging the validity of the UTPR. And this was from a Chamber of Commerce in the US, in the United States, called the American Free Enterprise Chamber of Commerce. And then several weeks later, a couple months later, 4 other, what they refer to as interveners, have joined. And those are other US state chambers of commerce. What is this lawsuit about? What is the basis of this? And then why Belgium? But talk a little bit about this lawsuit, because I think this is something that taxpayers really need to keep their eye on, because it really questions the whole validity of the UTPR, at least on the European.
Yeah. So in Belgium, if a law is voted, and as an interested party, you believe that this is not in line with European legislation or with the constitution, you can file a claim against that with their constitutional court. And that's exactly what happened. So what happened is that a number of arguments have been put forward why the UTPR legislation in Belgium would be violating the directives and other basic rules. That constitutional court cannot judge on its own on certain validity of these European law arguments, and has reached out to the European court to get some clarifications, some guidance. So we will see now, first of all, in the process, a judgment of the European Court, which has to be followed then by the Constitutional Court.
I see.
And the Constitutional Court will have some additional Belgian arguments that it will need to take a position on. The first question is that the court will look into is whether there is a genuine interest of these parties to challenge the Belgian UTPR legislation. What I hear from colleagues, it's not my key area of expertise, but what I hear from colleagues is that the Constitutional Court basically, and only in very rare cases, would accept that it's not acceptable at game.
We call that standing in the U.S. for any U.S. lawyers that are listening. But
But to be seen, I think that will be the first question that the court will need to judge on, whether there's a standing. Second is that, of course, whether these UTPR challenges are rightful. And there are a couple of very interesting ones. One example that is given in the claim is apparently about the fact if you have one small Belgian company being part of a larger group, that the Belgian company could be liable to a tax which excessively exceeds its own profits. And that's mathematically completely right, I think, that example.
Like could bankrupt the Belgian company to pay the UTPR for the group.
Exactly. And in Europe and in Belgium, we have this principle that you cannot be deprived of your property in an unjust way. So the question is whether such a huge tax assessment on a Belgian entity way above its profits, whether that is not a deprivation of property. And that's will be one of the key questions, I think, will be answered in this case. So it's very interesting to look at, but the big uncertainty that comes from this is, of course, that this judgment of the Constitutional Court will not be there in 25. We know from previous procedures it takes several months, years before a judgment is there. That means that taxpayers in Belgium, but I think everywhere in Europe, because this judgment in Belgium could have relevance, for all member states in Europe, will need to be very careful when they file their UTPR returns in the future. And maybe they need to take protective measures already to safeguard their rights.
Yeah, and just to make sure that I'm clear on that, point being is that, well, first of all, this is the Belgian Constitutional Court. They're going to have to get a guidance or reference the European Union Court of Justice,
yes,
which will obviously take time. And then Belgium will then need to give its own particular rulings, and the likelihood of that happening by the end of 2025 is remote.
Yes.
Right? Like, probably will not happen. But the issue is that the UTPR is effective in 2025. And so if you have that tiny Belgian subsidiary under the rule, you would need to potentially make advanced tax payments that could otherwise bankrupt that Belgian company until we get clarification.
Yeah.
Very fascinating. And the other thing one other thing I'll mention on the standing is that if the Belgian court would come and say that these chambers of commerce do not have standing, I will speculate that there may be some taxpayers that actually have standing or that are subject to these rules, may follow suit. But we'll certainly keep following that one very closely.
Yeah.
All right, maybe to just wrap things up here, Peter, what advice do you have for Pillar 2 taxpayers in Belgium?
Yeah, I would definitely make sure that you speed up and get as a taxpayer in Belgium, I would make sure that you get the information from the group, from wherever the information is available. It's often not easy. If you're a Belgian headquartered client, company, you have the information at hand. But if you are a taxpayer, part of a larger group outside of Belgium, I would definitely make the right connections within the company to get all the information in time.
Yeah, Belgium, I think if there's one thing that listeners can take away from this podcast, if you're not a Belgian headquartered company, Belgium is going to be the catalyst for taxpayers to actually get their data process in order to be able to do the registration requirements, any advanced payments, understand what their constituent entity analysis is particularly for maybe those non-public companies. But Peter, this has been insightful. I'm very excited to finally have you on. The timing is great with respect to all the developments. So thanks for coming on, and really appreciate you sharing knowledge on Pillar 2 in Belgium.
It was a great pleasure, Doc. Thanks.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Pieter Dere, International Tax and Transfer Pricing Partner at PwC Belgium. I'm Doug McHoney, PwC's International Tax Services Global Lead. Stay tuned for another exciting edition.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.